Good afternoon. It's 12:30 now, so welcome to today's lunchtime presentation. This week we're covering growth and value strategies, and so it's entirely appropriate that we have Jon Henry, who's investment specialist for Monks Investment Trust. Baillie Gifford's Global Alpha team took over Monks in 2015, and it was in 2017 that the trust started to regularly trade at a premium to NAV, which really continued through till early 2022, which saw market sentiment weigh against pretty much all growth strategies, and Monks has not been insulated from this. It now trades on a discount of about 10%. I'll hand over to Jon in a minute, but first a bit of housekeeping. You'll all be muted during the presentation, and we have 15 minutes for questions at the end, so please do use the Q&A function at the bottom right hand side of your screen to ask questions. I'll try and then group them together and address them to Jon. So over to you now, Jon.
Well, thank you very much, William, and indeed thank you for everybody for giving me the opportunity to give you an overview and an update on the attractions of Monks. Just by way of a brief introduction, my name is Jon Henry. I'm a specialist on the strategy and on the portfolio, and I work closely with the portfolio managers, Spencer Adair and Malcolm McCall, in looking after both the board and shareholders. So I think that the place to start perhaps is just to give a very brief overview of and a reminder about what Monks actually is, and then we'll delve a little bit deeper into what we think the attractions of the trust are, perhaps some of the opportunities that we're seeing in the market today, given the volatility and the changes we've seen in the market over the course of the last 12 to 18 months. So turning to the first slide then, Monks is an investment trust company, long-term and focused on capital growth. We have around 120 holdings, so a majority of those holdings are listed, with a modest exposure to some of the most exciting private companies that we can find globally. The trust is also modestly geared at around 4% net gearing at the moment. And I think the main attractions are firstly the flexibility the trust has. So we have three different types of growth that we invest in. So we recognise that the growth comes in different forms, and we can look to lean into or tilt the portfolio towards these different types of growth depending on what's happening in the broader market and the opportunities that we're seeing. The second is that we're global, so we have the ability and the latitude to invest in companies anywhere around the world. And importantly for Monks, we're really plugged into the different equity teams right across Baillie Gifford. And again, I'll come on to touch a little bit more on that later. And importantly and finally, we're low cost. So we have a tiered management fee, so that as the trust scales, the management fee due as a proportion of assets to the manager falls. So current ongoing charges figure is 40 basis points. And where we took over back in 2015, as William mentioned, that was 58. So we've been successful in reducing the fees that investors have to pay within the portfolio, and our ambition is to continue to do that. Now, a quick word on the team and the resource behind Monks. I mentioned earlier that I work closely with Spencer Adair and Malcolm McCall, both of whom are partners of Baillie Gifford, and they have significant experience in equity markets. So between them, on average, over 22 years experience, and indeed they've been managing the underlying Global Alpha strategy upon which Monks is based for the last 17. I think it's important to be completely clear that the team is well resourced. So we have 4 dedicated analysts listed in the middle of the slide there: Helen Jong, Kieran Murray, Jared Anderson, and Jacob Teal. They're dedicated to the Monks portfolio and seeking opportunities. And then we also have a very well-resourced scouting network. Now, these are not the Baden-Powell type, but these are individuals, and usually either partners or senior investors who are placed in our regional equity teams or in some of our strategy specialist teams, like, for example, the smaller companies team within Baillie Gifford. And their job is firstly to put forward the best ideas from their teams for potential inclusion within the portfolio, but also to challenge us on the existing holdings. I'd really say, look, I think you should be potentially thinking about selling this stock and instead buying this suggestion. And that's an important dynamic within the portfolio and the way that we manage it. I think now it's important to set out what we believe in as investors and in the way that we manage the portfolio. And I think this can be distilled into three key principles: belief, focus, and task. And our belief is that it's really important that companies sustainably compound their earnings over very long periods of time, because ultimately that's what we believe drives share price appreciation. There can be periods during which that relationship breaks down, like we've seen over the course of the last 12 to 18 months. But if you take a long-term view, 5 years or more, the evidence is that earnings growth consistently drives share price appreciation. We're looking for companies to exploit the competitive advantages that they possess to drive that earnings growth. And importantly, today, the portfolio is made up of a vast majority of companies that are already delivering earnings and have been growing their earnings at an attractive rate. So, for example, 95% of the Monk's portfolio is currently EPS positive. The second point was the need to focus and be active in the way we manage the portfolio. So it's really the few that matter. It's the few in global equity markets that actually drive long-term returns. A vast majority of companies that are listed in the end destroy value or create very little value for shareholders. So it's really the exceptional companies that we must go and find, invest in, and patiently hold within Monks. And then thirdly and finally, it's really important that we are patient long-term investors. So we want to give companies time to grow. We want to give management teams time to implement the strategy. We want to challenge those management teams and support them through potentially difficult time. But also we recognize that companies are not perfect. And what we're looking to try and do here is build a portfolio of companies that are improving, both from a strategic standpoint, but also from an ESG standpoint. Not all the companies we hold are perfect, but we need to see positive signs of progress against different metrics and in different areas to continue to hold the companies within the portfolio. Now, I mentioned earlier that we have a broad definition of growth, and that gives us and affords the trust a level of flexibility and adaptability. And what you can see now on the slide are the three different types of growth that we have for Monks. We recognise that companies grow in different ways, and we look to embrace this by investing and holding the portfolio across these different growth profiles: growth stalwarts, rapid growth, and cyclical growth companies. And we can, as I mentioned earlier, slightly lean in or tilt the portfolio towards these different types of growth, depending on what's happening in markets around the world, and indeed what's happening, as we've seen, with rising inflation rates and general increased uncertainty in equity markets. So, for example, we're beginning to see significant opportunities within the cyclical growth area. We've been undertaking significant levels of research in different areas and are quite excited about some of the opportunities there. But just a quick canter through some of these growth profiles. Number one, the growth stalwarts. These are steadier businesses, larger, usually quite entrenched, with loyal and sticky customer bases, an ability to grind out earnings growth, usually in the order of around 10 to 15% per annum over very long-term periods, again, 5 years or more. So the example we've used there is Analog Devices, which is a semiconductor, an analog semiconductor business, which has one of two major players globally and an ability, as I mentioned, to effectively gradually increase prices in the delivery of semiconductors, which are becoming ever more important in pretty much every application that we use these days. The second category is rapid growth. These are quite different in nature to growth stalwarts. These companies are growing their revenues usually exponentially, but often can be investing heavily and sometimes take longer to become profitable or to generate earnings growth, owing to the fact that they're investing heavily to secure a strong competitive position in their industry. Now, we've used Adyen as an example here, which is a European payments business, which is disrupting the payments network and growing simpler and more efficient payment solutions for merchants in Europe principally, but increasingly around the world. And then finally, cyclical growth businesses are companies that are subject more to the macroeconomic cycles, but particularly capital and business cycles within an industry. So, for example, semiconductors and the number of the semiconductor businesses that we hold in this portfolio would be classified as cyclical growth businesses. But the example we've used here is a company called Martin Marietta, which is a building and aggregate supply business, principally based in the US, that has a strong capital allocation discipline. So when it's experiencing down cycles, they invest heavily, and that tends to leave them very well positioned as markets improve, pricing and volumes improve, and they continue to cement, no pun intended, their competitive position. And at the bottom of the slide there, you can see that the mention of our growth hurdle, which is really important. So whilst we embrace a breadth of growth within the portfolio, we do maintain a high bar for growth within the portfolio right across the three different growth profiles, which is we want to see at least a 30% opportunity that the share prices of all the holdings in the portfolio can double on a 5-year view. Now, the next slide that shows you the portfolio, which is, there's a lot on here, as I mentioned, with 120 holdings within Monks. So I thought I might introduce the structure of the portfolio and then touch on a couple of positioning points. The first is you can see the split between the different growth profiles for the portfolio along the top. So we've about 37% invested in growth stalwarts, 33% in rapid, and 27 or so in cyclical growth. And then down the left-hand side, you can see the holding size discipline that we have, which is our larger holdings are around 2%, mid-sized holdings around 1%, and our small holdings at 0.5%. The important point to note there is that the holding size is positively correlated with the conviction we have or our perception of the probability that the company can meet the growth hurdle I mentioned earlier, that could double on a 5-year view. So the larger holdings are those that we have most conviction around, and the smaller holdings are companies where we recognise that the skew of outcomes is greater or wider, but we want to hold those companies on the basis that we're really looking for a handful of them to do very well and become much larger positions, and it's likely that those businesses will be the ones that drive the returns within the portfolio over the long term. When we've done our analysis, it's clearly showed that those incubated or smaller positions have actually added the most alpha of the three different holding sizes that I mentioned. It's also worth just acknowledging that actually the diversification between the growth profiles works. So consistently, the portfolio outperforms more often together rather than any of the individual growth profiles. So the benefits of diversification are real and work over long periods of time. Now, William mentioned that the performance has been more challenging recently. Monks continues to focus resolutely on long-term returns. And those have been strong since the Global Alpha team and Malcolm and Spencer took over back in 2015. But the past year have been challenging. Growth has been out of favour amid a period of rising rates, rising inflation, initially as a result of the pandemic, and laterally compounded by the war in Europe between Russia and Ukraine and the impact that has had on oil prices. And then subsequently the central bank reaction in terms of rising rates and the perception from the market that has on growth equities. And growth equities, therefore, have been very much out of favour as investors have looked for jam today, for companies that are delivering earnings growth today and what they can very much see in front of them. So I think that the point to highlight here is that while share prices have been sharply down in certain parts of the Monks portfolio, the companies have actually been doing pretty well across the board. So, for example, the earnings growth on average over the last 5 years within the Monks portfolio has been around 35% more than the broader index. The companies within the portfolio, we think, are much less susceptible to rising interest rates than the broader market. So if we look at the balance sheets of the companies in the portfolio, we think they're roughly 5 times stronger. So the net debt to equity of the portfolio in aggregate is around a fifth of the index. But I think really, going back to the attractions of Monks generally, I think it's important that we recognise that Monks has benefited from the last decade, which has seen low rates and low inflation being a relatively benign environment for growth companies, typically of a tech nature or online businesses, of which Monks holds several. But the changing environment, we think, lends itself quite nicely to the approach that Monks takes and its ability to embrace the different growth opportunities that we see. We think growth is likely to be much broader based in the future as shareholders and investors look more towards the bottom line, more towards companies delivering earnings and delivering positive cash flows, and that we are able to invest as growth investors in a suite of businesses which are able to do that and deliver that consistently over long periods of time. So, for example, we've been investing in businesses like flooring businesses, in drainage businesses, and semiconductor businesses recently, which are more cyclical in nature, that we think can be very attractive investments on a long-term view. I think it's important that we revisit, in amidst this, one of the key facets of Monks' approach, which is really that the earnings growth is what matters. And the chart here shows that the positive relationship between earnings growth and share price returns. So this is effectively a long-term study of share prices correlation with underlying earnings per share growth. And what it shows is that the top quintile of companies that deliver earnings growth, i.e. the highest growers, are the ones that are able to consistently deliver the highest share price returns. And conversely, the companies that fail to deliver earnings growth or deliver negative earnings growth are the companies that consistently deliver low share price returns and lower returns for shareholders. So what we're really looking to do is that whilst Monks can adapt and tilt towards the slightly different styles of growth, we're resolutely growth investors and looking for companies that can grow their earnings. So we want to identify those companies and we want to hold them. We want to be brave through difficult periods, which is what we've experienced over the course of the last 12 to 18 months. So what about a little bit more colour around the types of opportunities that we're seeing and why we're excited about the Monks portfolio at the moment? What we're showing here is that 3 different areas where we think could be potentially very exciting. Now, the first is cyclical companies with structural underpinnings. So as the market today is highly uncertain, investors are, we think, potentially undervaluing companies that are cyclical in nature but have structural growth opportunities. So, for example, we've taken a position in Integris, which is a semiconductor business which makes cleaning and filtration equipment for the production of semiconductors. The market, we think, is extrapolating a rather negative view for that business over the next 12 months, which might be the case. There may be pain to come for that business over the course of the next 12 to 18 months. But in a long-term view, we don't think the valuation attached to that company accurately reflects its long-term growth opportunity. Other names mentioned under that column include Pool Corporation, which is one of the largest swimming pool manufacturers and maintenance businesses in the US. Most of our investment case centres on, for Pool Corp, centres on the maintenance and upkeep and upgrading of swimming pools right across the US. Again, that's going to become a necessity for large swathes of swimming pools right across the US, and we think that it should lead to pretty attractive returns on a long-term view. But it's another business which is quite cyclical in nature, but is facing near-term headwinds in the current market from a valuation standpoint. And then a final example there would be Advanced Drainage Systems, which we've recently purchased for the portfolio. Effectively, what we're talking about here is a company that makes plastic drainage solutions to replace the concrete equivalents. Plastic is cheaper, it's more durable, and it's more efficient. We think that it's very likely that structural trend will continue, but again, a cyclical business which the market is not appreciating at the moment. So we do think there's a number of opportunities in the cyclical area that could lead to very attractive returns for the Monks portfolio. But the second area is what we've called disruptors on sale, and these are some of the companies that I think, in all honesty, some of the companies that have performed most poorly in share price terms within the Monks portfolio. So we're talking here typically technology-led businesses, usually online business models. And these are the companies that have been investing heavily for future growth, that the market doesn't like. So we've been very carefully distilling the companies that actually, sure, there are some that are challenged, and where that's been the case in an environment where inflation is increasing and rates are higher, we've sold those from the portfolio. So there was 2 or 3 companies that we sold, but by and large, we've retained the majority of the positions in this part of the portfolio, and we're very optimistic about the outlook. So we've added to the likes of Farfetch, which is an online luxury goods business, and Coupang, which is a groceries and a food delivery business in South Korea. We're continuing to look closely at others. We took a position in Mercado Libre, the Latin American e-commerce business, which is increasingly becoming a really central player in the micro lending and credit market in Brazil and Argentina and Mexico, which are some of its core markets. We think the market's short-term view again here leads to an opportunity for us as long-term and patient investors to add to and invest in a range of quite exciting businesses. And then thirdly and finally, capital allocators with firepower really as a nod to the fact that the funding environment has changed. As I'm sure you're all aware, interest rates have risen sharply, therefore capital and funding is scarcer for businesses. And that has the effect of separating, if you like, the wheat from the chaff, the winners from the losers. And we think that it's very likely that companies that have capital, i.e. cash on the balance sheet or cash that's ready to be deployed, are in a very strong position. So we're looking very closely at opportunities to invest or add to positions where we think that management teams are in possession of capital and they're sensible allocators of capital at this point in the cycle. So we have existing positions in companies like Process, the European investment business that has a stake in Tencent, the Chinese internet business, and Microsoft, which I'm sure all of you are familiar with, as it continues to invest and grow its suite of services and increasingly its cloud computing business. So I'm conscious that the time is moving on, so I wanted to leave you with a couple of things. Firstly, some further reading, which I think is for those keen beans among you. The Monk's Research Agenda is something we produce every year at the start of the year. It's a helpful framework for our own thinking around where we might be seeing attractive opportunities to invest in businesses. For example, there's content in there relating to the importance of patience and why we believe that we have a significant advantage in being long-term patient investors in the current environment. There's content in there relating to infrastructure upgrade and the need globally, developed and emerging countries, to upgrade the infrastructure, be that energy infrastructure, roads, any other type of infrastructure, which is likely to lead to significant opportunities to invest in some of the picks and shovels businesses and the suppliers to several industries. And also a section that really emphasizes the importance of the supply side. So thinking, as I mentioned, about who can provide capital and how can they deploy that capital effectively, but also who might be consolidating industries or sectors, who might be buying up competitors, what is a challenging operating environment for businesses. But all of this really encourages us to be focused on the long-term moves in the market and to think about where the next generation of winners are likely to come from. So some concluding thoughts, therefore. I think number one would be that I think Monks is suitable for long-term savers who are looking to grow their capital over periods of 5 years or more. I think that the recent weakness that we've seen in share prices, whilst uncomfortable for shareholders, is an opportunity for Monks' adaptable growth style. The team is seeing a broadening opportunity set. Hopefully I've given you a flavour for some of that. And there is an increasing competition for capital within the portfolio. We do believe that now is really the right time to deploy our patient approach, and it's likely to be able to allow us to invest in a range of companies that are capable of delivering attractive returns for shareholders on a long-term view. So with that, I'm happy to finish there and really take any questions you've got. I believe William will pass them my way.
Absolutely. Thank you very much, John. So we've got a decent number of questions here. I will please do put some more in if you want. I will try and group them together and make them as logical as I possibly can. So I guess the first few questions on really, are there any sort of set parameters of companies that you invest in? Is there a minimum market cap or a maximum PE or a or any of that?
Well, we typically for Monks we're I mean that's a good question, because for Monks we're actually slightly less constrained than the kind of core Global Alpha strategy. So just as a bit of context here, Malcolm and Spencer run the Global Alpha strategy, which is a range of segregated clients and open-ended pooled vehicles, but also Monks. And Monks is able, by virtue of its closed-ended nature, able to go a little bit further down the market cap spectrum. So we typically look at companies that are for Global Alpha that are no less than 4 billion in US dollars market cap, but we can go a little lower in Monks because of the closed-ended structure. And clearly we have the unlisted element too, where we have much smaller private companies, albeit a relatively modest part of the portfolio. So we're able to go quite far down the market cap spectrum. We don't, in terms of valuation and other parameters. I mean, we have a broad kind of diversification guidelines, no more than 6% in any one company, and we have some sector and regional guidelines. But generally speaking, those are quite wide in nature and intended to avoid any unwanted concentrations within the portfolio. And in terms of valuations, we would tend to look on a case-by-case basis. The valuation that's demanded for a company which is very high growth will look very different, at least on a multiple basis, PE basis or an EV to EBIT basis, to a company that's more of a kind of compounding type of growth, where you might be saying, look, actually, I'm looking for this company to compound over the next 5 or 10 years. So we tend to take those on a case-by-case basis.
Thanks, John. A sort of related question is there's a number of questions about sort of profitability of the portfolio, and obviously, within your rapid growth category, for instance, what percentage of holdings have negative earnings, i.e., unprofitable? And do you, in terms of profitability and earnings, is that do you focus on cash earnings or non-cash earnings? And I think you were saying that you were reshape the portfolio a bit towards focus more on companies that are profitable. But is your reshaping of the portfolio finished, or is that a work in progress and a bit like the Force Bridge, never quite finished?
Yeah, sure. There's quite a lot in there. So I'll try and set the scene a little on profitability. So the Monks portfolio currently has around 95% of the portfolio is cash flow positive or EPS positive. To break that down a little bit more, 90% are EPS positive, and therefore the remaining 5% to take us up to 95% are cash flow positive. When we look 3 years out, so we forecast out, the forecast would take the portfolio to about 96% EPS positive businesses. So we think, from a quality perspective, this is a high quality portfolio. I mentioned some of the aggregate statistics in relation to levels of debt within the portfolio. So this portfolio is made up by and large, a significant majority of companies that are profitable. In terms of the rebalancing within the portfolio, we undertook an exercise in February, March last year, whereby we assessed the inflation resilience of every holding within the portfolio. We said, look, if there's going to be a period of increased or elevated inflation for a persistent period of time, 3 years or more, how do these companies cope? How do they fare? So we looked at measures like pricing power, we looked at the speed of the business cycle, we looked at levels of debt, etc. What we got out of that was the need to trim or sell a handful of holdings, what we're calling weeding of the portfolio. So companies like Peloton, which was unsuccessful investment for Monks, Carvana, recently Oscar Health. So we've sold the holdings that we think are most susceptible to what might be regarded as a more challenging environment for growth businesses. We will continue to review the holdings, I can never say that we won't continue to do that. That's an important part of the process. We now have more in the compounders, or the stalwart businesses, today than we did 12 months ago. So that rebalancing has happened. I think we're at the stage now where we're forward looking. We're looking at the opportunities that are available to us, and by and large, those we think are more cyclical in nature, or we might be looking to actually add or invest in some of these rapidly growing companies that we think have been unfairly punished by the market. So I think we're in the second part of that phase, the allocating capital across the portfolio. And that's likely to happen over the course of the next 6, 12, 18 months.
Thanks, John. And I guess in that way, is there any part of the portfolio that you could say was a value allocation rather than the growth allocation? I mean, it's definitional, but
Yeah, I mean, I think the value versus growth kind of debate is always a slightly dangerous one, because there is a huge level or degree of subjectivity here. For example, I know that some of the holdings that Monks has, from an index perspective, have been moved around between growth and value index. So Alibaba, for example, I think has been moved into one of the value indices. So it's almost a slightly dangerous one. I wouldn't call any of the holdings that we have as value investments. We're firmly looking at the growth case. I would say that there is greater valuation element perhaps to some of the cyclical stocks that we invest in, where we think some of them can be deeply undervalued, where there's a very clear arbitrage to be had on the valuation, and then we see some sort of secondary kicker for growth and returns in the future, which is the growth angle. We would never choose to invest in something within Monks where it's a sort of valuation arbitrage opportunity. We always see a growth leg to the story, but perhaps acknowledge that valuation might play a bigger role for some of the cyclical names in the portfolio.
Thank you. And I'm sort of putting two questions here, different questions together here, but what's the percentage of unlisted companies in your portfolio? And on the same sort of subject, I guess, what's the rationale of holding closed-end funds like Herald and Schiehallion?
Yeah. So that's the first question. The total unlisted exposure for Monks is about 4.2% today. In terms of what's the rationale, so those two you mentioned are very different in nature. The first being Schiehallion. Now, Schiehallion is a late-stage private investment vehicle, listed private investment vehicle for late-stage private investments, and it's managed by Baillie Gifford. And we have around 2% of our 4% invested via Schiehallion. Now, Monks wants to keep it simple. We want exposure to private companies. They're an exciting area of investment and for long-term investors. We think the best way of doing that for Monks is to invest in that vehicle. Our preference is that a majority of Monks' exposure on a long-term view would be through Schiehallion, through the team that's dedicated to looking at and analysing private investment companies, or private opportunities, I should say, from right around the world. And we think they're better placed to do that than Malcolm and Spencer, whose focus is by and large listed equities. So that's a core proponent of our unlisted exposure within Monks. The Herald Investment Trust is in the portfolio and was inherited when we rolled over the assets of the Independent Investment Trust in November. So the Herald Investment Trust was operating at a very wide discount. That discount has come in somewhat, and it's most likely the case that position will be moved out of the portfolio in time, as the discount looks a little bit more attractive. We took receipt of that asset as part of the rollover, probably with a view that it wasn't going to be a very long-term holding, but it didn't make sense to liquidate the asset at such a wide discount at the point of receipt via the independent merger.
And segueing neatly into a question on that transaction, what percentage of Independent's underlying portfolio has been retained versus sold at the moment?
So roughly, it was roughly half of the independent portfolio came across to Monks. Now, it was a very, very thorough process in terms of reviewing that portfolio and being quite clear about what we wanted to receive and what we didn't want to receive. So we've only received assets that we liked or that we felt there was a reason to hold for a period of time. The context here was that the total transaction equated to around about 7% of Monks' total assets. We received 4% of the 7 was stock and 3% was cash. So 100 million in stocks, 73 million in cash, and actually a very advantageous time to receive both stock and cash, but actually cash in particular. Monks has continued to buy back shares as it looks to look after the interests of existing shareholders. But also, as everyone will be aware, the sharp falls in equity markets leads to a good time to be allocating capital. So that 73 million arrived at an advantageous time in the performance cycle.
Thank you, Jon. There's a question here on the discount. What is the discount policy on buybacks? Which admittedly is the board's decision. So
yeah, exactly. So the board. So that's the first point I was going to make. So the board are the arbiters of that, and the board's view is that when we were trading at the premium, Monks was issuing consistently at sort of 2 to 3%. On the buybacks, we've been buying back consistently. Monks is among one of the largest, if not the largest, buyer back of its own shares in the global investment trust sector in the last year. So I think throughout 2022, Monks bought back 9% of its issued share capital, or its outstanding share capital, I should say, at the start of the year. And the Monks board, therefore, is very active and is mindful and keen to protect the interests of shareholders via buybacks. The difficulty, naturally, is that the market's been so volatile that it is sometimes difficult to attribute the effectiveness of buybacks. We continue to monitor that in conjunction with the broker and with the dealing desk at Baillie Gifford. But certainly, it's been front and centre for the board to make sure that they can do everything to narrow that discount and keep it at a level which is advantageous for existing shareholders.
Thank you. Another investment trust structural related question is gearing.
Yeah.
Can you just give a quick overview of how you employ gearing and
sure. Yeah, absolutely.
And the cost of gearing as well?
Sure. Yeah. So Monks is currently has a structural view, a long-term view to gearing. So we don't dip in and out of the market, and we don't tactically time our gearing. We have a flexible structure where we seek to approximately half short-term and half long-term debt. So Monks currently has a revolving credit facility of 150 million sterling, and then it also has 100 million in long-term debt. And it's a very timely question because we very recently repaid a 40 million debenture. That was a 40-year debenture that Monks had just last week. And the board are actively reviewing the next steps in terms of replacing that long-term debt. But generally speaking, we have half long-term and short-term debt with the objective of being approximately 10% geared on a net basis. Now, that's not a target, but that's what we're calling a neutral position. So all things being equal, we'd like to be geared into market growth and returns. We think that's an attractive way to deliver returns add to returns for shareholders. We're currently 4% geared on a net basis. And the objective, as I say, is when the time is right to deploy gearing at the right point in the cycle. Obviously, that was very difficult when Monks was doing very well, and we didn't want to be gearing into a rising market. We want to gear counter-cyclically so that it generates more attractive returns for investors. We're at the point, I would say, in the cycle where deploying gearing it is more attractive. In terms of the cost of that gearing, it varies. So the revolver is a variable rate revolver. So it's currently around about 5% given the increase in rates. But naturally over the past sort of 12 to 18 months, prior to the rises in interest rates, that's been much lower. And the long-term debt is really very attractive. We raised that 2 years ago at 100 million sterling with a coupon rate of about 1.8%. So that has been a very good decision for Monks on a long-term view.
And then zooming back out again, there's a few questions on whether the team employs sort of top-down views on as part of their investment process, and is market timing considered? Obviously, you're not doing market timing with gearing, but is that implemented as part of the investment process? And if you do take top-down views, have you got any particular views on China and emerging markets?
Yeah. Okay. I'm just writing the elements of that question down. So, do we take top-down views? We are bottom-up stock pickers. So really, our process is set up such that individuals within the team and the wider Scout network are following their sense and their enthusiasm for individual companies. We don't construct this portfolio. For example, we don't say, well, what's our healthcare exposure? Do we want that to be more or less than the index? Do we want it to be a certain proportion of the portfolio? That's not how we construct the portfolio. So the outputs of the portfolio, or rather the allocations within the portfolio to different sectors or regions, are very much the output of the bottom-up stock picking process. That said, it's important that we do recognise the changing environment operationally for businesses. So clearly, as I mentioned earlier, the environment where inflation is rising, rates are rising, the impact that may have on the consumer. We have thought about the portfolio and its exposure to that, of course. You mentioned China. We have, of course, thought about the changes that we've seen in China over the past 2 years, the regulatory imposition, the changing stance of the Chinese government to private enterprise, private capital, and the potential impact that has on the portfolio. So in answer to your question, that part of it, we're firmly bottom up, but we do consider what might be regarded as macro or some top-down considerations, because we realise that we can't pick stocks in a vacuum. These things matter to companies. So we try and take account of that by considering how it affects the portfolio from a bottom-up perspective. With regards to China specifically, Monks has sold down a meaningful portion of its Chinese exposure in the last 12 to 18 months. So today we have around about 3% of the portfolio invested directly in China. The number's a little bit higher if you include companies like AIA, which is a Hong Kong listed company which does significant business in China, or Shiseido, which is a Japanese business which has significant Chinese exposure, more like 7 or 8%. But nevertheless, I think we recognise that the operating conditions for companies in China are more difficult. The probability of supernormal returns that we look for in businesses are less likely today than they were 2 years ago, 3 years ago. And therefore, we need to be more selective about the opportunities that we do take within China. So what I'm saying is that we still think there are exciting opportunities in China. The original reasons that we chose to invest in China, the large market, the high degrees and levels of innovation, they persist today. But we do think that private enterprise in China is unlikely to be as profitable, and that's important for us as bottom-up stock pickers focused on companies that could deliver earnings growth. So I would say that in short, the opportunities, we need to be more selective about them in China. We need to be more aligned with the strategic goals of the Chinese state. So, for example, they've been very clear about the areas they want to invest in: electric vehicles, semiconductors, advanced manufacturing. Those are the sorts of areas that we think it's likely that the most attractive investments will reside, and that will be our strategy moving forward.
Thank you so much. Do you hedge any of your underlying currency exposures?
No, there's no hedging in this portfolio. We don't take any currency positions, principally because we don't think we're really very good at that. And there's an opportunity cost there in terms of the time that we would spend considering our currency exposure versus just getting on and researching companies and finding some of the best growth companies out there. We do consider currencies again from a bottom-up perspective. So, as an example, we were looking at a Taiwanese business, and we like the fundamental operations and its growth profile. But we did speak to our rates and currencies team about the currency and the views that they had. And in the end, we decided that that wasn't an attractive investment on the basis that any revenues and earnings that that business did generate, when translated into hard currencies like dollars and sterling, probably wouldn't translate attractively for the portfolio. So in that sense, we do consider currency from the bottom up perspective, but not from an overlay or currency management perspective.
Thank you. One last question. Thank
Sure.
you, Jon. You've been very good at answering many questions all at once, so apologies for
That's okay.
grouping them together in what I thought was a logical way. Last question, dividend. What's the policy on Monks' dividend?
Yeah, so the dividend for Monks, I mean, we pay the absolute minimum by way of a dividend to maintain our investment trust status. Monks is all about capital growth and long-term capital growth. So any income we receive is reinvested back into the portfolio, and dividends are paid, as I said, at the absolute minimum to maintain our investment trust status.
Fantastic. Thank you so much, Jon. And thank you all for dialing in. Tomorrow at a slightly later time of 3:30 to allow for the West Coast US time zone, we've got Mike Seidenberg, manager of Allianz Technology Trust, presenting from San Francisco. Please do join us for that. Details, if you haven't signed up, are on the Trust Intelligence website on the events page. But it remains only for me to thank Jon once again on your behalf.
Thank you.
Thank you so much, and see you later.
Bye-bye. Thank you.
Thank you.